All right, class. This is our last chapter, chapter 18 on cash flows. So good job getting to this point. I just wanted to record this video so that you have it to be able to watch at any given point in time before our final exam, which is next week. So I'm going to go ahead and share with you the PowerPoint for this chapter. I'm going to take myself down so that we can, you don't see the ceiling. And I am going to expand this a little bit so that it's a little larger. Yeah, that's better. All right, and so, I'm sorry, not chapter 18. We are covering chapter 17. We already covered chapter 18. But last chapter 16, we were talking about or operations, all right, money coming in from operations. And, we talked about the component of working capital. And again, working capital are current assets, subtract current liabilities. Okay, that gives us working capital. All right, and so in this chapter, we're just going to delve in more with the management of that working capital. And so key concepts to understand: how a firm manages cash and various collections, concentration and distribution techniques, how to manage receivables and the basic components of credit policy, and various inventory types, all right, different inventory management systems, and what determines the optimal level of inventory. And so really, we're focusing in on, those current assets and current liabilities. And so some of the components we're going to be talking about: float, cash management, collection, distribution, investment, credit and receivables, inventory management, and such. And so John Maynard Keynes, hopefully you've heard of him. He's probably one of the, I wouldn't say founders of economic thought, but he definitely has had a lot to say on that. So hopefully from your experience with Econ 1 and 2, you've discussed them. All right, but his idea for the reasons for holding cash. First of all, there's a speculative motive, all right? And, speculation, all right, is when you don't really know what was going to happen, but you just want to make sure that you're ready for it, all right? And so, if you've ever heard of like a spec house, okay, when somebody builds a spec house, they don't have a buyer for that house yet, all right? And so they're building it on the hopes that somebody will like it and purchase it. It's speculation. Right? And the hope of this motive is to take advantage of unexpected opportunities. All right, and so you have excess cash in order to be able to make moves in the market and hopefully gain an advantage overall. And so we kind of talked a little bit about that last chapter when we talked about the idea of restrictive versus non-restrictive monetary policy. And so, speculative would basically be unrestricted or loose. All right, so we have excess cash. Well, I guess this whole idea of having cash, right? There are two parts. We want to be able to make moves, right, in the market that we are unaware of, but then there's also the precautionary motive, right? And that's really what we've started moving into, obviously, with this pandemic. Making sure that we have enough cash to sustain operations during the downturn. All right. Then there's the transaction motive, right, to be able to pay the day-to-day bills. And then there's you need to understand that there's a trade-off, okay, between holding cash, right, and making the cash work for you. Right? And really, the opportunity cost of holding cash versus the transactional cost of converting marketable securities into cash. And so really we're focusing in on, the cash management here. Right? And so understanding Float. Okay, float is the difference between the cash balance recorded in the cash account and the cash balance recorded at the bank. And in accounting 201, we actually, or I should say not accounting 201, but for you accounting majors, when we were in auditing, we actually on our last exam, had to do the cash cutoff, right, to make sure that people weren't taking advantage of float, all right. And so here's the idea, okay. Um, and this isn't as prevalent these days as it used to be, just because of the speed of technology. But basically, we'd write a check, all right, and we wouldn't record that disbursement in one account, right? But we would record it in the account that it's going into. All right, so we make a transfer from, let's just say, savings to checking. All right, well, we put it into checking before we actually take it out of savings, and this really allows for you to overstate your cash, right? Because you basically have double the cash of that transaction. All right, so float is the difference between the cash balance recorded in the cash account and the cash balance recorded at the bank. All right? And so there's different types of float. All right, there's disbursement float, all right, and that's generated when a firm writes the check. All right, and so the available balance at the bank is going to be more, okay, than the balance per the books. And so the available balance of the bank, all right, subtract the balance of the book, all right, if this is greater than 0, okay, that's considered to be disbursement float. Right? And so obviously the bank doesn't know you wrote the check because the check hasn't been cleared. Then there's collection float. That's on the flip side, all right. The checks received increase the book balance before the bank credits that account, all right, or reduces that account. And so the available balance per the bank, subtract the balance per the book, right, is less than 0. And so the idea is, that you have people writing you checks and you're writing checks, all right. And so the disbursement float would be us sending checks out, where collection float would be checks coming in. Whereas net float, okay, equals the disbursement float plus the collection float. So management, all right, dealing with float, managing float. Management's concern is that net float, okay, and the available balance in your checking account. Because the whole idea is that we don't want to bounce a check, because not only are we going to potentially damage our relationship with our suppliers, but also your bank's going to charge you, all right, charge you a fine. Okay, so how we can manage float, all right, in various different ways. And again, with electronic fund transfer, a lot of this is old, but collections, disbursements, okay, can be managed through mailing time, okay, to speed collections, decrease 1 or more, okay, processing delay, okay, running it through the bank, and the availability delay. I don't know if you remember, but this used to happen, a while ago, that you might get a check from somebody and you put it in your bank account, but you can't access those funds, all right, for 5 business days. All right, that does not happen as frequently as it used to. Okay, now sometimes there's a little bit of a delay, being able to access that cash. All right, and so the idea to speed up collections, all right, decrease 1 or more, to slow disbursements, okay, increase 1 or more of these things. All right, and so again, are we talking about disbursement float, where we're writing the check, or are we talking about collection float, where we're receiving the check? And so the best of both worlds, okay, would be our disbursements are slowed down, okay, and we're slowing these things down, but yet our collections, we've sped those up. All right, we get the money and we get it through our system and into our checking account as fast as possible. Float issues, all right, kiting, all right, is the idea of systematic overdrafting, all right, writing checks for no economic reason other than to exploit the float. again, kiting is been pretty much not eliminated, but definitely decreased dramatically because of this new Check 21. All right, Check 21 basically is a picture of the check can act as the actual check. All right, so if you've ever taken advantage of your mobile banking, you got a check and you don't want to run to the bank, you can take a picture of the front and the back, all right, and it will post to your account, all right. That's really what Check 21 is, right? But kiting, used to happen a long time ago, where what we would do is we would cut a check, right, and we'd mail it to some sort of bank on the other side of the country, all right? And so because we had snail mail, all right, and it took a long time for that check to get to one place or the other, it wouldn't clear for a certain amount of time. Now, I think that the movie, I remember, it's called Catch Me If You Can. All right, I think it had Leonardo, whatever his last name is. I used to say DiCaprio because I wasn't a big fan. All right, but several movies he came out were pretty good. But that whole movie was the idea of him scamming people by kiting checks. All right, so his bank might have been in California, and he was on the East Coast, and he was buying things, and he was writing checks, all right, on this bank that was on the other side of the country. And so just the time that it took for that check to clear, he'd be gone, and he would have converted whatever asset he had into cash and basically defrauded, all right, people. So pretty good movie. Check it out if you want. All right, but that's the whole idea of kiting, right? It's trying to take advantage of the system, right? As I said, a lot of that has gone away because of electronic data interchange, all right, or EDI, okay, direct electronic information exchange, which is pretty much instantaneously, through the internet and whatnot. Okay, and so here's an example of different types of float. You have $300 or $3,000 in your checking account. You just deposited $2,000 and wrote a check for $2,500. Okay. And so the disbursement float, okay, well, that's going to be the $2,500, isn't it? Okay, because we just wrote that check, $2,500. Our collection float, okay, is this $2,000, right? Okay. So net float, right? Do we add these or do we subtract them? Right, we add them, don't we? 4,500. Okay. And so what is the balance per your books? Okay. Well, our balance per our book, right, we had 3,000. Okay. We deposited $2,000, so we had 5,000. Okay. Then we subtract 2,500, and so we have 2,500 left. Right? But what is your available balance? Okay. And so, we have the 3,000. Okay. We deposited that check. All right. Well, until that clears, okay, it isn't included in. And again, it really depends how that check came in. But yeah, the check that we wrote has not cleared. Okay, so depending on how you look at it, we either have 3,000 or we have 5,000. Right, so the 3,000 plus the 2,000. Right. So cash collection. So we kind of talked about this, a bit, in last chapter when we talked about the operating cycle and things along that line. All right. However, looking at as far as the collection delay. Okay, so this is us trying to get our cash, right? The customer, okay, he first of all mails the payment. Okay, then we receive the payment. Okay. Then we deposit that payment, and then we have the availability of that cash. Right? And so, this idea of mailing time, okay, so it's mailed, if it's coming from the other side of the country, it may take 3 or 4 business days. You know, once we get it, we may keep it in our safe at our location. Okay, so we receive it. Okay, so we may take a couple days, all right, until we actually bring it to the bank for deposit. Okay, and then there might be a time lag, right, where that check is clearing before we can actually have the cash. This is all referred to as the collection delay. The goal, all right, is to reduce the collection day or collection delay. All right. So different ways to do that. All right. We can do over-the-counter collection. All right. So this is great because, you know, we've got the cash right away. All right. So there's no need for them to mail it. All right. And then, you know, have that sort of delay. We actually have a cash register, and they give us the cash, give us their checks or whatever. Another way, pre-authorized payment system. Okay. Payment amount and dates fixed in advance. Okay. Payments automatically transferred. All right, and so you guys are all familiar with this. You know, when you set up, you know, auto pay, right, with your phone, or I do mine through my phone, but you know, I pay my utilities that way. Well, not my utilities. I pay my, you know, the transactions that are pretty much set. So my cable bill, my internet bill, my rent, or not my rent, but my mortgage. All right, so those are automatic. You know, I just have automatic pay. Okay. And so if we can set other people up with that, okay, then they don't have to wait. And it's funny because I actually was able to, if I set up my Verizon, I'm with Verizon, and we have 4 lines. And if I set up auto pay, all right, they gave me Disney Plus for free for a year. Okay, and so that was the little encouragement that I needed in order to set up auto pay for that. And yeah, they're trying to, you know, make sure that they can take that money out of our account, right? And they don't have to wait all that time. So the due date is on the 30th, all right? You know, that they're not waiting till, you know, sometime in the first week of the next month, right, in order to actually get that cash. Then we have payments via mailed checks, okay? And so, you know, this obviously is going to, you know, be based on the mail service, okay? And so, you know, the idea is, are we going to just have them all come to, you know, to one place, okay? Or we're going to have various different collection points, right? And so, you know, if you're a large enough organization, you know, you may have these drop boxes that we'll talk about here in a minute, you know, around the country, you know, so that the people from the Pacific Northwest, they're not mailing checks to Florida, okay, where your business headquarters are, or something to that effect. All right, and so they have these collection centers around the country, shortening the you know, the mailing delay. And so we can utilize lock boxes and cash concentration points. Okay, and so a customer checks are mailed to a PO box, you know, and you can have various different PO boxes around the country. Local bank, all right, you know, so if you're using PNC, you know, they have offices in Seattle and they have offices in Kalamazoo, you know, so, you know, the PO box actually you know, they have access to those PO boxes, all right, and so they go get those checks, all right, and you know, they deposit them into the accounts of the business. All right, again, what we're doing is we're eliminating, you know, the mailing time. Firms may also have lockbox arrangements around the country. You know, so if we have you know, business operations around the country, we don't have to rely on the bank. All right, but the same idea happens. All right, you know, we're shortening the mailing delay of these transactions. Cash concentration, all right, equals the procedure to gather funds into the firm's main account. Okay, and yeah, this reduces mailing and processing times. So here's the idea. Okay, you know, we have 2 different lock boxes, or you know, post office boxes. All right, and so the customer payments on the East Coast. All right, In the West Coast, you know, they go to different locations, and that just saves time for stuff being mailed. You know, we do this. I don't know if you realize, if you ever mail in your tax return, you know, our tax return processing centers are located around the country, right? And so I believe it used to be when I was in Hawaii, we'd have to mail our tax returns to Fresno, California, right? Whereas I think we mail ours here, Cincinnati, Ohio. Okay? You know, so that's the whole concept, is you have different locations. What they do is they deposit into you know, the local bank, right? And then, or I guess they go through the process. So they pick up those, local banks pick those up from the post office box, right? Envelopes are opened and separated checks, right? Receipts. They deposit those checks in the bank account, okay? And the bank checking clearing process. The details then go to the firm, right? And they record the receipt of those payments. Just another look. You know, instead of having the post office box, okay, what we're having over here, right, is you know, we have various different sales offices. All right, you know, so the West Coast sales office, you know, the customer payments come in there, right? They deposit them in the local bank, right? As those other ones are coming from, you know, the post office boxes, you know, they're coming into the local bank, right? We concentrate all those funds, okay, and the firm cash manager then, you know, allocates those to the specific places that they need to go, right? You know, that maintains the cash reserves, right? Any kind of distribution stuff, and then short-term investments. So cash disbursements, we want to delay these, don't we? These are desirable, okay, because it allows us to have the cash in our banks, potentially collecting interest, all right, you know, for a longer period. Slowing down payments can increase distribution float, okay? Mail checks from a distant bank or post office, you know, may not be ethical, all right, or optimal, okay, but people used to do that, at least, not so much anymore. Controlling distributions, all right, there's a zero balance account and a controlled disbursement account, just different ways to control your stuff, all right? And so a great example of this zero-based account would be payroll, all right? You know, where, you know, transfer one time into the payroll account, right? And then all the electronic fund distributions come out of that that payroll checking account, right? And this just helps with, you know, the time of doing reconciliations and whatnot. And the fact that if you know that, you know, that balance goes down to zero, you know, that everybody has processed their checks. So a firm maintains a master bank account and several sub-accounts. Banks are automatically transfer funds from the main account to the sub-accounts as checks presented for payment. Okay. So this is a zero-based balance, all right? Requires safety stock buffer to maintain in the main account only. And so here's a really nice picture of this, all right? Where no zero balance, okay, so you know, they don't have a zero balance here. So we have these two, you know, different payroll accounts, and then, you know, just your general supplier accounts. You know, this is where you pay your suppliers out of. If we use if we don't use zero-based, okay, we're going to have safety balances, okay, in both of these accounts. Whereas if we just use, right, the zero-based account, something similar to this, we only have to have one safety stock. Does that make sense? Okay. And so anytime we need money, we transfer it to those other accounts, right? And they will always end up to be, you know, zero after everything that has been written out of those accounts have been cleared. What do we do with the extra cash? All right, so various different things. All right, there's money market accounts, all right, which are just financial instruments, okay, with maturities that are less than a year. And generally, these things earn more interest than a regular checking account. Okay. Temporary cash surplus, all right, you know, in last chapter, we talked about the seasonal and cyclical activities, right? So when we have excess cash, we're going to buy the marketable securities, right? And basically, we're investing it, right, to earn interest. Okay, and then when we need it, we just cash those out. Okay? It's again less than a year, so it's very liquid. Planned or possible expenditure. All right, we could also accumulate marketable securities, knowing that hey, we need to have X amount of cash, all right, in order to buy that new equipment, and so we're basically earmarking that money. In accounting, we refer to that as reserve, okay, or what's another name for it? I can't think of it now. All right. But a special fund that we're setting up. And so here's a picture, okay. When we have the excess cash, we invest it, all right, into the marketable securities. When we're in peak activities, that's where we have to borrow some additional cash, all right. And so, we, in this case, we're doing short-term financing. We're borrowing here, okay, and we're investing here. Characteristics of short-term securities, right? And so, again, we do talk about this in Accounting 202, right? When we talk about marketable securities, right? And really, there's two types of marketable securities, right? There's investing securities, and then there's available for sale securities, right? And so in this, really, we're not making that big differentiation, right? The whole idea is, we've got this excess cash, right? We want to invest it in something where we're not going to have to pay any penalties in order to get it out. Right? Firms often limit the maturity of short-term investments 90 days to avoid loss of principal due to changing interest rates. So with short-term securities, there's several things that we have to be concerned about, and the big one is the default risk. Right? Avoid investing in marketable securities with a significant default risk, all right? So we want to find things that are relatively safe. When we find things that are relatively safe, all right, we're going to get a smaller return, right? But the idea is that we need this money, right? We're not doing it for, speculation, right? We're just parking our money here in the temporary so that we'll be able to take it out when we need it. Marketability, ease of converting to cash, all right? And so when we talk about marketable securities, there has to be a market for those securities. And so really all we're saying is publicly traded investments where we can buy and sell these things with picking up a phone call. Taxability, all right, consider different tax characteristics when making the decision. All right, so there is this thing called capital gains tax, all right, and there are special rules when it comes to capital gains. Short-term are taxed higher than long-term, and so you just need to take that into your consideration. When do you need those funds, okay, versus paying additional tax? So some key issues, all right, when it comes to credit management, okay? And so this is when people are asking us for terms, okay? My big input on this is make sure you call their references, all right? It was hilarious how many people would list people on their credit application. I'm assuming that they didn't expect that I'd actually call them because they gave them terrible references. They were like, do not sell to these guys with terms because they just take forever to pay, or, blah, 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 blah. That owner, he doesn't know what he's doing. You may never get paid. It was hilarious. All right. So, this is us. We're trying to determine, should we give somebody credit terms, right? The goal or the purpose, all right, of giving credit terms is that people generally buy more, all right? However, the cost of granting credit, all right, is that customers, there's a possibility that they won't pay, okay? And then there also might be the financing of receivables. So with credit management, all right, the trade-off between increasing sales and the cost of granting credit. Because, basically, so let's just say that, not even taking into account the 210 net 30, all right, let's just give people net 30 straight away, okay? And so really what is happening, all right, and on the flip side, we're taking advantage of this credit stuff too, right? We're basically, so let's say we're the ones borrowing the money. We got net 30. So, or we're not money, we're borrowing, or we're purchasing inventory on account. We got 30 days, right? So we're in essence financing the purchase, right, of that inventory, right, through the supply. Okay, we've got 30 days. The hope is that we can sell at least half of it, okay, making the assumption we have 100% markup, that we can sell half of it before the 30 days, pay off what is owed, and then the second half is just all profit. Right? So that's the idea that we're using, or people are using us, okay, to finance their operations in the short term. Because if you remember when we had our discussion about leveraging your company, you can actually, right, be more profitable, okay, by using liabilities or credit. And so here's the cash flow, okay? Again, we make the credit sale, okay? We wait until maybe 30 days, all right, depending on your terms, all right, before they're going to mail the check, all right? And then here's the cash collection just from, from the side of, I guess in this case, if we made the sale, this would be from our perspective, all right, where we have the cash collection, all right, and again, our goal is to shorten that cash collection. And this, all right, would be the total time, okay, of the accounts receivable. So components of credit policy, all right, terms of the sale, credit period, usually multiples of 30, cash discount and discount periods, all right? So if you remember the whole concept of 210 net 30, okay, that we give them a 2% discount if they pay within 10 days. If not, the net amount is due in 30 days. Credit analysis, distinguish between the good and the bad customers, all right? And so you want to definitely call, all right, their references. I mean, we never put anybody on our credit applications that we didn't know for sure that they would give us a positive credit history. Our collection policy, efforts to expand or expended on collection of receivables, right? So do you have a dedicated department for accounts receivable? All right, is this just the one of the accounting clerk's responsibilities to call and collect? All right, because I don't know if you've ever heard the term, the squeaky wheel gets the cheese, right? Or the squeaky wheel. The squeaky wheel gets the oil, all right? The squeaky mouse gets the cheese. All right, ooh, look, conflict of my metaphors, right? But yeah, being present and being, them being aware that you need to get your money, right? Is important. Credit period determinants, all right? And so, here we have factors and how that's going to impact, the credit period, right? Perishable goods with low collateral value, you want to shorten that credit period, don't you? Okay. So if you're selling vegetables, okay, that they're going to perish within 10 days, okay, you don't want somebody being able to pay for that thing, pushed out to 90 days, do you? No. All right, you want to shorten the credit period. Low customer demand, okay, well, in that case, you want to give them longer credit terms. Low cost, low profitability, and highly standardized, again, you want to give them a shorter period because, more likelihood that you won't get paid all right, if you give them longer credit terms. High risk, definitely shorter. Small accounts, definitely shorter. Competition, all right, so people are out there selling the same thing, all right, you might be able to attract people because of your credit period. And the customer type, that can go either way, increase or decrease. So terms of the sale, all right, we talked about this already. 210 net 45, all right. We encourage them to pay a 2% discount if they pay within 5 or 10 days. If not, the total amount is due within 45 days. Know that it is generally worth taking advantage of any kind of terms, all right, or discounts that you can, all right, because this 2%, okay, 2% is not the typical interest, right? That's 2% on, really, in this case, 35 days of financing. And so, they're just giving us an example. And back in Accounting 201, all right, we actually proved, okay, that even if you had to borrow, okay, the money for 35 days, okay, you're going to take the 35 days over 360, okay, and if you had an interest rate of, you're borrowing at maybe, I don't know, 7%, and you multiply this times, I don't know, the total amount, let's say it was $20,000. It's actually better, all right, to borrow the money from your bank, pay the 7%, okay, and take advantage of that discount. It makes monetary sense. So here's an example of finding the implied interest rate when customers do not take the discount, right? And so we're basically working backwards, right? So in my scenario here, if we took, if we could borrow money at 7%, all right, we're in essence saving, all right, or, at this current calculation, we're basically, the interest, the annualized interest rate, all right, of 210 net 45, okay, is 23%, right? Versus borrowing it at the bank, all right? And yeah, maybe you couldn't get 7%, but anything under 23%, right? And I can pretty much guarantee you can borrow money for cheaper than 23%. It'd be worth doing. Okay? The company benefits when customers choose to forego the discounts. Okay, but the flip side, if you are given those credit terms, you better take those credit terms. Right? They're beneficial. Credit instruments, basic evidence of indebtedness. All right, there's an open account, most basic form. Okay, invoice only. Okay, then we have the promissory note. Okay, so an open account, accounts payable, accounts receivable. Promissory note, accounts notes, I should say, and accounts payable. Accounts, whatever. Notes receivable, notes payable. All right, so accounts payable, accounts receivable, notes payable, note receivable. Okay, so depending on which side of the transaction you are. Okay, this is verbal. Okay, this is written. Okay, that's really the biggest difference. Okay, this one generally has an interest rate. Okay. This has no rate. Okay. Credit instruments. All right, commercial draft. Okay, and so when we're dealing with instruments, we're basically dealing with well, it's the type, all right, of credit that we're either giving or getting, right? So there's a site draft, right? Immediate payment required, sometimes referred to as COD, right? Then the time draft, okay, not immediate. Okay. When the draft presented all right, the buyer accepts it, right, indicates their promise to pay, okay, sometimes referred to as trade acceptance. The seller may keep or sell the acceptance, okay. The banker's acceptance equals the bank guarantees the payment, all right. And so, something I think we skipped through, the seller of the good may keep or sell this acceptance, all right. That's referred to as factoring. Okay. That's when you go to a third party, and instead of waiting your 45 days, all right, you sell it to a financial institution, and they give you the money right away. Okay. And so it's referred to as factoring. Okay. The optimal credit policy, all right, so carrying costs, right, required return on receivables, loss from bad debts, okay, cost of managing credit, all right, and collections, all right. And so these are all the costs, all right, if we give somebody credit terms, right, okay. So the carrying cost, all right, we give credit. Credit. Wow. All right. Okay, so these are all things that would increase your carrying costs. Right? When you give credit, the required return on the receivables, because there's a timing aspect of that. Losses from the bad debts, people not paying you, right? And then really the cost of managing credit and collections. Right? So what we're doing is we're comparing, the cost of giving somebody credit versus a cash sale. If restrictive credit policy, which means that we don't give out credit very easily, okay, our carrying costs are going to be low. However, we may miss out, okay, on potential sales, right? Okay. Because people are like, well, you don't give credit, I'm going to buy it from somebody else. If we give more liberal credit policy, okay, we have excess capacity, we have low variable operating costs, all right, and the potential for repeat customers. And so at Faith Routing Company, we basically said, hey, everybody's first transaction with us was COD. After that, we, based on their credit application, we'd determine whether we give them terms. And so our goal, right, just like any economic thing, is to find that sweet spot, all right? The optimal amount of credit that we're going to give, all right, is going to be the equilibrium between the difference of the carrying cost, which we just talked about, and the opportunity cost, the missing out of sales. All right? And so it's at this point, okay, all right, that we have found equilibrium. Okay. So credit analysis, all right, the process of deciding which customers receive credit, all right, credit information that you will request, right? Financial statements, credit reports, past payment history, their banks, all right? Payment history with the firm. Okay. To identify the quality, all right, we're going to look at 5 C's of credit. Okay. And really, a lot of that also is wrapped up in their credit score. Okay. And so the 5 C's of credit, right? The character, all right, the willingness to meet their financial obligations, so they have integrity, okay. The capacity, they can meet their financial obligations, all right, out of operating cash flows, all right. Capital, okay, do they have sufficient capital? Can they, if they need to, can they borrow money? Collateral, are they giving anything? Are they pledging that inventory that they're purchasing as collateral? Okay. Because obviously, if you have collateral, you have less risk, therefore less interest, right? And then the conditions, really looking, this is outside of the customer, really looking at the general economic conditions, all right? And so, with this pandemic, things are tight, okay? All right, so that really is going to impact, are we going to be giving people credit? Our collection policy, all right? Monitoring the receivables, all right, watch average collection period relative to the firm's credit terms, all right? So, when we did this, we did the number of days in sales and receivables. Okay. And, so let's say that we had 35. whereas the majority of our customers, we gave them that 30. Well, they're paying 5 days later on an average than they're supposed to, right? Okay, and so we just look at that and keep our hand upon that, because it could be that we're not doing the a good enough job in collecting, or it can be an indicator on the market as a whole, right? Because you're not going to pay when the market's bad, right? Typically. Collection policy, all right, generally you want to send out a delinquent letter, all right? You might want to give them a telephone, all right? Send them to a collection agency, and then take them to court, all right? At Faith Writing Company, we pretty much stopped right here, okay? We never utilized a collection agency. We, looked into this, all right, but it was just not cost effective. Because basically we're going to take them to small claims court. We have to pay all the court charges. If we hire a lawyer, we're going to have to pay that, all right? And I think we did it once, and we won, but we never were able to collect because, if they're not paying you, they're probably not paying you because they don't have any money, all right? And so, yeah, you could put a lien, all right, but then, you may never get paid for that. Okay, so really is dependent on the organization. Switching now to inventory management. Okay, with inventory management, because this is part of your working capital. All right, so inventory, large percentage of the firm's asset. Okay. Inventory costs, again, the cost of carrying too much inventory versus not carrying enough. All right, and so very similar, okay, to the opportunity cost, okay, and the carrying cost that we talked about with cash. Right, we're going to have that same issue here. All right, because if we have inventory, okay, we have a lot of things that, the carrying costs of, we have to store that inventory. We have to manage that inventory. Our money is all wrapped up in that inventory. But yet, if we don't have that inventory when people want it, okay, we're going to miss out on that sale, right? Okay. So inventory management objective. Find the optimal trade-off between carrying too much inventory versus not enough. So there's different types of inventory. Okay, so with a manufacturing firm, again, this is from Accounting 202. All right, we have raw materials, work in process, finished goods. Right, those are all inventory accounts. One firm's raw materials is another person's finished goods. Right, so when we purchase this, okay, we're buying it from somebody else. Okay, that's their cost of goods sold, isn't it? Delivered versus independent demand, right? Or derived, okay, sorry. Derived versus independent demand, have no idea what that is even talking about, so probably not that important. Different types of inventory vary dramatically as far as the form of liquidity, all right? Insert all my stories about how purchasing too much inventory, board shorts, at a time when there was a downturn in the economy, September 11th, it almost killed Faith Writing Company because we could not convert our cash that was in that inventory into cash to purchase new T-shirts, right, to meet the demand of those T-shirts. It almost killed us. So inventory costs, they estimate that about 20 to 40% of inventory value, right, per year. Those costs include storage, tracking, insurance, taxes, losses due to obsolescence, things going out of style, right? Computers having an older processor, right? Deterioration, theft. Okay. Really, this is and the opportunity cost of capital, because if we have our money tied up in the inventory, then we can't use it for our other operations. Storage costs, okay, consist of restocking costs, lost sales, or lost customers. Okay. And again, what our goal, all right, is to find that sweet spot, okay, where we have the lowest restocking costs, right, and the lowest carrying costs. We're finding that equilibrium, right, as it relates to inventory. And really, what we're going to be talking about is this optimal size of our order. Okay, so how many units should you order every time? And so inventory management, okay, classify inventory by cost, demand, and need. Okay. Maintain larger quantities of items that have substantially low or substantial shortage costs. Okay. Maintain smaller quantities of expensive items, and maintain a substantial supply of less expensive basic materials. All right. And so when you're trying to determine how much inventory to carry, these would be factors, all right, that you need to consider. Economic order quantity. Okay, this is how many you should order. Okay, so when you're putting in an order, purchase order, how many units should you purchase? Well, you can look historical and just say, oh yeah, on average we sell about this many, and so we need to have this many moving into the future. All right, but there is a statistical equation, right, which is the EOQ. All right, and what it does is it minimizes total inventory cost. And so the components of this, all right, Q equals inventory quantity in each order. Okay, and so dividing that into two, or dividing that by 2 gives us the average inventory. T represents the firm's total unit sales per year. Okay. So T divided by Q, right, equals the number of orders per year. CC equals the carrying cost per unit, and F is the fixed cost per order. So total carrying cost, right, is the average inventory times the carrying cost per unit. Total restocking costs, right? So once we make that order and we have to, put it in the shelves and things like that, right? So there's going to be a fixed cost per order times the number of orders. And so the total cost, right, of making an order equals the total carrying cost plus, right, the total restocking cost. We need to be able to develop that, okay, in order to put it into our equation. Right? So total cost, right, from the previous slide, total carrying cost plus total restocking cost is broken up into this, right? And so the question is, right, what quantity, right, should we purchase? And so basically they take that and they convert it into this equation, all right? Okay. And what this allows us to do, right? And again, if you have a EA2+, this makes it super easy. I left mine in my office and have not been able to get back there, all right? But basically you can find the square root button. It's above the numbers. Right? And it's just a square root. Okay. And so basically what they're doing is they're trying to figure out, hey, how many, oops, went the wrong way. Okay, how many units should we order every time we make an order? And so we consider an inventory item that has a carrying cost of $1.50 per unit, the fixed ordering cost, right, $50 per order. And so, this might be your purchasing department, all right? And we've been able to identify that every time that they make a purchase, it's going to cost us $50, right? Fixed cost. That's going to stay the same, right? And the firm sells, the 100,000 units per year. Okay. What is the economic reorder point, right? And so they run this through. They take, the 2 times the 100,000, right, times the $50, okay, and they divide, okay, by the 150, and then they take the square root of that. And so in essence, what they're saying, right, is that every time we order whatever this is, okay, we're going to order 2,582 of those items. Okay. Extensions to this, right? You know what, maybe we want to put in a buffer or a safety or a cushion, you want to call it. You know, we might modify that. Okay, minimum of inventory kept on hand. All right. However, this does increase your carrying costs, so it's something to consider. Reorder points, okay, really takes into takes into account, okay, you know, how many units you sell and how long does it take to put together an order. Right? And so we actually talked about this when we talked about inventory back in Accounting 201. Okay, and I generally use the example of Walmart and shampoo. You know, so it takes 3 days to process a purchase order and receive the product. We sell on average 3 bottles of shampoo every day. Okay. So how many days, right? Or what would be our economic reorder point? Our economic reorder point, not quantity, is 3 days, right? Okay, so, or I should say 10 items. So when we sold that 10th item, we have 9 bottles of shampoo left on the shelf. Okay. We know that it takes 3 days to process an order, and so what we need to do is we need to put in the order as soon as we sold that 10th bottle. Okay, that's the economic reorder point. Demand-derived inventories, all right, materials requirement planning. Okay, so this is computer-based ordering scheduling system, right? Works backward from setting the finished good level to establish levels of work in progress required. All right, so this is for a manufacturing firm. Just-in-time inventory. Okay, when we set our economic reorder point, the end of that 3rd day when we are selling that last bottle of shampoo, right, our inventory is now arriving just in time so that we don't lose any of the, you know, potential sales, but yet we are lowering our costs of maintaining the inventory. Okay. And again, this was a Japanese system, right? Yeah, which has been applied not only to inventory, but also to manufacturing systems and whatnot. We talked about those before. Okay, cool. Well, that's the end of chapter 17. Today in class, we're going to review our last exam, which is optional for those that want to take it. But if not, as long as you do the homework for chapter 17, 16, and 18, you will be able to be done. All right. I'll see you in a few.